Hello everybody and welcome to the fifth video of the series. Today our topic is passive versus active investing and an intro to risk management. We'll start off with the definitions. Passive investing is a strategy that aims to match market performance through broad, long-term exposure with minimal intervention. That means you buy and hold, in simple terms. The hard part about passive investing is picking out assets to invest in most cases. Active investing, by definition, is a strategy that attempts to outperform the market through a selection, timing, or tactical decisions. For active investing, timing and execution is very, very important. For active investing could be buying the dip or day trading, for example. Well, these have different sources of returns. Passive investment usually gets returns in the form of market return or economic growth or compounding over time, whereas active investments get returns in forms of individual decision making to a much larger extent, identifying inefficiencies in the market, and timing and positioning. Well, it's the same thing that both do, but it's over different periods of time. For example, passive investing could be years up to decades, whereas active could be within seconds. But both are doing the same thing, buying low and selling high. But passive relies on the system, whereas active relies on execution. Now, these have different risk structures. The risk for passive investments is a market-wide decline, for example, a crisis, or long-term exposure, whereas active investments have the risks of decision risk, timing errors, and over-concentration. Moving on to risk management. As we've discussed in previous videos, risk is the probability and magnitude of loss. Now, the markets come with a risk versus return trade-off, where high return expectations often require high risk. Well, that is often in the case of leverage or investing in slightly riskier stocks or assets, whatever. And the biggest problem is there is a loss asymmetry, where losses have a disproportionate effect. For example, if you lose 50%, you need 100% return on the initial balance to get to where you want it to be in the first place. And that is what makes risk management hard.